As always, excited to be here with you today. And on this topic, I realized this looking back, and I thought I'd covered this topic before, and I haven't personally covered the topic. We've had some speakers at Note Camp. We've had somebody on Note Night in America talk about the specific niche of note investing. I call it a note investing strategy, but they call it more of a real estate investing strategy. And I think it's a mixture of both, and I think you'll understand why I talk about it. Now, what strategy am I talking about? I'm talking about subject to deals. Now, subject to deals, what is that first and foremost for those that are listening and don't know? A subject to deal is where a property owner, borrower has fallen behind, maybe in their mortgage, maybe they're moving, maybe they're going through the big D, divorce, or they have had something happen and they want to get out from under their mortgage. Maybe they've moved because of work, maybe they're in the military and they are being repositioned, restationed somewhere else. And they got this mortgage that they don't have the time to take care of it, and by either putting a renter in place or selling the property, or maybe they bought a property at the peak of the market, which is what we see kind of right now. People paid more than market value, and then the market values have dropped. So they may have negative equity, maybe underwater a little bit. They may owe more than their property's worth. They may not have the money or the equity to sell the house traditionally and pay the realtor commissions because their mortgage is too high. There's a variety of reasons why people would be willing to get out from a deal, get out from a property. We've heard a lot of things, like I said, divorce, job loss, job movement. There's a lot of people will hurt for a variety of reasons out there in society these days. This doesn't be that. I mean, think about it. Recession's high, inflation's high. People are having to make decisions between paying their either mortgage payment or putting food on the table. And when you look at like the average car payment, it's like over $700 a month. That's a mortgage in itself for what it used to be. My first house back in 2001, 20 plus years ago. So a subject to deal as an investor, what are the pros and what are the cons of that? Well, a pro is that you're coming in, you're helping this borrower get out from under a mortgage that they can't pay anymore by taking over those payments. And you might take over it by, assigning the property, deeding it to an LLC or a land trust, a different entity, and you start making those payments on time again. And they might be a couple months behind. You might have to come to the table with a few months of payments and pay that to the bank to get them caught back up. You might need to have the borrower work out a loan modification agreement or forbearance agreement with a bank that you can step in and take over. So the advantage for us as investors is we're acquiring property with low interest rates. And we've had historically low interest rates for the last couple of years, right? We've had a lot of appreciation, and some people are like, well, I'm not going to do that. I just sell my house. Well, great. Sell your house then. You're not my ideal client. There's a lot of people out there that can't sell their house. Like I said, they owe more. They just don't have the money to handle it. Maybe the house needs to be fixed up in some cases. We see that with a lot of elderly folks. So this is a great way when people can't pay their mortgage, struggling to pay their mortgage and need a way out. You as an investor can step in and help them. Now, what are you doing to help them? Well, if they've missed a couple payments or behind, you're immediately helping them by getting them caught back up, or getting their credit, I should say, caught back up. You're not going to start making payments on their behalf until they've deeded the property or you've taken over ownership of the property and they've moved out. Because you want to control that. That's your asset, basically. Now, you're not in the hook for the mortgage. They're still on the hook. If they haven't made payments, they can't go get a traditional mortgage, get financed for traditional mortgage for at least 24 months, especially if they've got more than one late pay. Because no bank is going to finance anybody with 2 late pays in 24 months. They got to wait for those late pays to fall off, and then they would be qualified. So you're technically helping that borrower rebuild their credit. There's nothing more damaging to a credit report than a mortgage late, especially 2 late. Get 60 days late, that will drop your credit score really fast. So you're really building in a 24 to 36 month cash flow stream here. By that means, yes, they hopefully have a very low interest rate that you can then compare it to. If you were to owner finance that property right now, interest rate would probably need to be at 9-10% if you're owner financing based on current mortgage markets here in 2022. You could rent the property. Rents have been going through historical rates. So if the mortgage payment's $1,200 PITI and you can rent it for $2,400 a month, guess what? That's a $1,200 a month cash flow. That's a great way to build cash flow of either arbitraging, making the mortgage payment and getting the difference between rental, or if you owner finance or do owner finance the property, do a wraparound mortgage, you're making the difference between what your end buyer is paying minus what you pay on the PITI. Now, you could actually do it on a lease option that's outside of Texas. A lease option where maybe somebody brings a big down payment down. You use that down payment to pay the rearages or pay it back. They're paying you monthly for 24 to 36 months as you're paying that mortgage on time. They're paying you. And at the end, what's happened? Well, there's three kind of profit margins in this. One, obviously, if you're doing taking over and doing a lease option, you're getting a down payment of some sort. And now the bigger, the better. I wouldn't do just 5%. You want to have this owner finance buyer that you're going to do terms for to bring at least 10%, 10% to the table. Then what's happening? Well, your principal on that mortgage is getting written down faster than the mortgage that you owner finance or did a wraparound. So there's a difference in that arbitrage of equity. Now, if you sell the house after 24 to 36 months, it's just a rental and you sell it, there's a big write down of that principal over 24 to 36 months. So, and then hopefully the house is appreciated some in 24 to 36 months. So those are the things. You get cash, you get some down payment on the front end side, monthly cash flow, and then you have that equity arbitrage on the back end. That's kind of the free profit margins of subject to. Now, there's great people out there that teach this. I'm a big fan of Chris Prefontaine, wicked smart real estate coach out of Providence area. Chris and his team, his family team really know their stuff. And if you're looking for a class just on that, that's what I highly would recommend. But we as note investors, have an upper hand in the subject to business. Now, most subject to investors, what are they doing to find these types of deals? They're looking for empty houses. They're looking for free and clear houses where they can get favorable terms for the borrower. They're looking for divorces. They're looking for distressed borrowers. Well, we as note investors, when you're reaching out to banks and asset managers and hedge funds, stuff like that, and you're getting listed in non-performing notes, even if these lists, these subject to investors aren't seeing because they're not getting the list of the mortgages or the bad mortgages from the banks. They're focusing on stuff that's like pre-foreclosure and waiting for that borrower to reach out to them. So we really have an upper hand in this deal class when you get in a list of notes. Now, yes, first and foremost, you want to try to buy those mortgages at a price that makes sense for you. 50, 60 cents on the dollar. Okay. But the seller, isn't playing ball that makes sense, or maybe they want too much for the asset. Guess what? Or even if these assets don't make sense at the price point they want, that you want to pay for them, if they're occupied, guess what? These are potential subject to lead deals for you. What? Well, Scott, didn't I sign an NDA not to contact the borrower to talk about buying their note? Yes, you're not talking about buying their note. We all know when we look at these lists that usually they have the occupancy, right? Now, you're not going to do these with vacant assets. I mean, you could, I guess you could, but for the most part, you want to target these occupied assets. Now, what do? Basically, get lists in. I make my offer to buy the notes because I get a better price at that point. That's my first and foremost action that I want to take is buying the note for my own portfolio, being the bank. But the bank will play ball, or there's assets I don't necessarily want to own. Invest in those areas. I'd rather get a mortgage already in place. New York State, New Jersey, those are states that are great for subject to deals. If you take over and you're the landlord, or you're the person responsible for the mortgage, we put it that, you've got a 3-year period, you get away with it if you want to, without paying. Not that you should do that. No, if you're a subject to investor and a borrower entrusts you to start making their mortgage payment time, you need to follow through on that. If you can't find a buyer or a seller, then the best thing to do is deed it back to the borrower and then let them deal with it. But if it's in an area, decent area and stuff with motivation, days on market, or especially if it's in that first-time home buyer category, and by first-time home buyers, I really mean $300,000, $400,000 or less, or you're in a market like, let's say Scottsdale or Phoenix, or the places out there where there's a lot of people looking for assets that have money but maybe don't qualify for the mortgage. This could be a great opportunity for you to get these under contract and owner finance the asset and get a nice down payment and have it financed for 24 to 36 months before a balloon kicks in on that, or do an option. So getting these lists in, what do we do with these lists? Like I said, I make my offers first. I pull out my portion of the tape that I'm making my offers on. If they don't accept those offers, or they say, no, that's fine, then what can you do? Well, you've got the borrower's information, you got the property address, you know how far behind, you have an estimated legal balance. It makes sense to drop a letter or a postcard out to these borrowers and say, hey, approach it from a subject to deal. You're not going to call these borrowers and say, hey, I'm trying to buy your note. If I can't buy your note, can I buy your property? No. You had some guys back in 2008, they went that approach, like, oh, hey, we're going to try to buy your note, and if not, we'll short sell your house. Big, crash and burn. Because if you're telling the borrower one thing, trying to approach it to it, we're going to buy your mortgage and modify it, and then you fail, well, let's sell your house. You lose all the skin, any type of rapport you've had with that borrower on the front end side. So that's why we don't. First of all, it's a violation of CFPB to contact the borrower, say, hey, we're going to try to buy your note and pre-modify it out unless the seller bank gives you permission. They're not going to do that. But we contact the borrower just like a realtor would. A realtor, when they get a list of foreclosed properties or distressed stuff, or any other investor gets a distressed list, what do? They go mail out postcards. They go knock on doors. Well, with us, we got 6 to 12 month head start on these deals. And it's great research. If you send out, let's just law of numbers, you send out 50, you're probably going to get a 1 to 4% response rate. Well, those can be tremendous deals, especially if they've got low interest rates. Now, I wouldn't be sending these out to, where there's a ton of equity. Those borrowers are probably going to want to fight you and want to stay in the house. But the upside down, or where there's little to no equity, low interest rates, specifically if a borrower is not paying in a faster foreclosure state, they know that things speed up. It makes sense to reach out and try to take over these deals subject to. Hey, we'll make your mortgage payment. We'll take over payments, avoid foreclosure, avoid ruining your credit. Because it does go to foreclosure, it's going to affect their credit for 7 years, not 24 months, 7 years before they can go get a traditional mortgage again. Okay. That's incentive. Hey, we'll take it over. It will take over these payments. We'll pay the taxes. We'll pay the insurance. You can go get your life back together, rebuild. Give us 3 years, 3 to 5 years, and we'll work on it. Why 3 to 5 years? Well, it's going to be 18 to 24 months in a recession where the market rebounds back. So it works for you because it becomes, like I said, it's an investment property. You've got financing in place with low interest rates, and you can wrap around or rent it out and make your arbitrage and hold on to it for equity. Do I pay the borrower, the original homeowner, a percentage of the equity? No, you're paying their mortgage down. You're fixing their credit. They're not entitled to any of the equity over time because you've been doing all the work. Now, I know some people that have done, hey, I'll give you 10% of the equity that grows. That's fine if that's a closing tactic for you. I just don't do that because you don't know where the asset's going to go. All right. Like I said, you always want to get a sizable down payment, 10% or more. That's enough skin in the game. But here's the thing, you're riding out this crazy wave. You don't worry about if the values drop and they come underwater. The bank is motivated to work with you on this because they're now getting a performing note, and a performing note is good to them. They don't want to sell this off. Does this violate the due on sale clause? Technically, yes and no. A due on sale clause on the mortgage is in place if the mortgage changes hands. And yes, it technically violates the due on sale clause. But I've only heard of a few, I've never had any bank actually enforce the due on sale clause. I've never enforced the due on sale clause when we've been the mortgage holder and found out that the borrower deeded the property to somebody else or let somebody else take over payments. I didn't care. I was just happy being the bank getting the cash flow. And that's the thing. When you start sending in payments, that's why you want to put it in an LLC. If there's insurance on the property, you want to also name the bank as the insured and you be co-named on this. You want to make sure there's an authorization for them to release information to you, have a couple of those signed so that you can send those in when you're communicating with the bank. But the bank accepts payments. If they accept a modification, accept a payment in cash, they don't hold it in escrow, but they actually deposit it in and goes towards it. If the bank finds out that it's sold and they start getting their panties in a wad about the due on sale clause, there's no judge in America who's going to side with the bank because the bank has accepted payments. They've accepted payments. You may want to notify the notification departments, a tactic that people have used before. I know other investors, hey, so-and-so is helping us make payments on this. We're just notifying in case the payments come from a different entity that's paid. All the bank cares about is that the payment comes in, the check clears, the cashier's check clears, and they've got the right loan number. That's really the extent of it. Okay? Because for them to get to the ability to foreclose on a due on sale clause, they would have to stop accepting payments for 90 days. And if you know that, You can make electronic payments pretty easy these days. They're not gonna reverse it. They're happy, fat and happy. Oh, the borrower owes more than the property's worth, and they're making payments. We're happy as a pig in slop. Okay. So that's what we talk about when it comes to subject to note investors. We're seeing so many different tapes coming in, and could you pull a list of some stuff off of some of the different listing websites? Yeah. Would you target performing notes? No, I wouldn't target performing notes because those borrowers are performing on time. Probably can be a waste of time, but the non-performing occupied assets, that's definitely a possibility. Now, I'll give you a couple examples of stuff that I did previously prior to Dodd-Frank. We would get listed and we'd send a letter out, hey, we'd like to take over your mortgage payment, or do you own? And we had people that would respond to our letter campaign and say, oh, I'm walked out, but if you want to take the property, we're glad to deed it over and let you deal with it. And we found some deed and lose that way when the borrowers reached out to us. If a borrower has moved on out of the property, most of the time they have mentally checked out of that asset. They're gone. And it may make sense to you if you do a skip trace, to track down these borrowers and see if you can't negotiate taking over payments or deeding over and figuring out where everything is at, or at least getting an authorization to release information and contacting the bank on their behalf. Because there's been times we've been working short sales or loan mods and things have drug out 12 months. We got one loan mod that drug out 4 years. And then the borrower was able to get back on track, get a job. Actually went to junior college or got a 2-year associate's degree and got back on track so she could start making the existing payments again. And we settled on where the bank just took those 4 years of payments and put it to the face back amount of the note. That's something you can negotiate. If you're looking at a subject to deal and the borrower's behind by 2, 3, 4 months, it makes sense to contact the bank to see if they would do a forbearance agreement. And then you just take over that forbearance agreement. That's a really powerful thing. One of the most important things, making sure taxes are paid, making sure you're dealing with the right borrower who has a right to sign off on this. And just disclosing there, it's a different story than when it's done. There's been a lot of new things happening with subject to deals and things you've got to disclose, and want to make sure your contract is ironclad. In the agreement, you don't want to get a phone call from a borrower in 2 years. Well, I need you to sell the house. I'm trying to buy a new mortgage, a new house. I said, sorry, you assigned in this agreement for 36 months. We'll do the best that we can, but there's an agreement in place. So that's something to keep in mind there, ladies and gentlemen. Always have your documents checked by attorney to make sure everything is legal. And every state's going to be a little bit different. So make sure you know what's going on in those specific states, because in some states you can do a lease option. In Texas, you can't do a lease option. You can do a lease option if it's to an LLC or an entity, but not to an owner occupant longer than 180 days. That's a violation. And I'll give you a great example. Somebody sent me a note they're trying to sell. Well, it's on a lease option, a contract for deed here in Texas. It's illegal. No wonder they only want like pennies on the dollar from like, good luck trying to foreclose on this asset on the middle of Timbuktu. This is actually an illegal contract. So make sure and run it by your attorneys what you're trying to do in specific states. That's why I like Chris Prefontaine and what he's doing, because he's really focused on different targets, different markets, and what's going on legal wise when it comes to subject to deals. So, but like I said, if you're a note investor, you're getting tapes in, lists of assets in that are occupied, these are great options for you to really work out. The numbers make sense. Great. Low interest rate. Look at the rent rate. This is one of the things during due diligence. Hey, what are the rent rates for this asset? If it's at 2%, what's a mortgage payment at 8% or 9% with the market being like it is? And what's that difference in payment to you? Taxes and insurance are going to be pretty much a wash through, but know what the difference is in your P&I payment versus your end buyer's payment. And you may want to make it interest only. I offer that up on subject to deals. I'll do it interest only, so it's the cheapest payment you pay monthly. So they're not really building any equity in, if it's an owner financing. Yes, they would have the equity above what they paid for, but they're writing down that gap between what we finance it for and the principal amount of that loan. So that equity position is a nice payday for me in 24 to 36 months on the back end. All right. So that's the thing. I wouldn't tell the bank, oh, I'm going to send out subject to letters. No. This is a different marketing piece. You probably want to have it come from a different entity, different phone number. That's what we did. We created a separate whole mailing campaign with a different entity and a different website that people will go to. And then we have people that would pick up the phone and call, skip tracers, VAs that would make the phone call to see if they're interested in trying to sell. Now, what's another great strategy if you're not getting note lists? Well, you could look at, have a realtor or a friend pull a list of expired listings, people who are trying to sell, who have pulled their house off the market. There's plenty of those right now. All right. All across the country, you've seen inventory increase like fourfold. Here in Texas or Austin, it went from like 2 weeks to 4 months. That's an 800% increase in product in a lot of times, or days on market, or things of it listing. Those are potential deals, because if they bought in the last 3 or 4 years or refinanced in the last 3 or 4 years, they've got a lower rate than what it was is now, or what it was back in 2018. So check that out. I mean, county records will often give you an idea when they do this stuff. You could also expired listings. You could also look at obituaries in a lot of cases. Do a letter campaign to obituaries, people that passed away, they own property. They usually owe more than one in the state. The spouse is left and doesn't really want to deal with it. We have some of that handiwork to do. Another thing that you might be able to take over subject to are great terms with 0% financing in some cases, is you're dealing with people who have property, but they don't want to sell it and have a big tax implication. So if they buy on terms, they're only going to get taxed on the amount that they receive on a monthly, annual basis, not the full sales amount. So that's a great tax incentive to make sure they're not getting huge tax bill on property that they're selling and paying those capital gains taxes, or whether it's a long term or short term. If it's a set up on a payment plan, it's a long-term capital gain, versus they sell a property, it's a short-term capital gain. Or if they've held on, it's going to be a capital gain. Sorry, short-term is they did it in less than 12 months, but if it's longer than that, it's a long-term capital gain. But nobody wants to pay Uncle Sam what they want to. So buying on terms and extending that for 24 to 36 months till things get better, or you've built enough equity in the property between what you owe and what the value is to sell it and cash in. So those are some great things. Out-of-state landlords, out-of-state property owners are a great source as well too for you. Especially right now, there's a whole amount of different lists. You might even target your local foreclosure list. If you're not in a state like Texas, is fast, in 21 to 51 days. It's hard to find subject-to deals by targeting the foreclosure list. You have a better rate of return by looking at expired listings or properties have been pulled from the MLS in some cases. So right now, ladies and gentlemen, as we record this, it's November. The idea is to get this stuff working for you so that come December, before Christmas, because nobody wants to move over Christmas and New Year's, but leads coming the first year. Get this stuff out. People will hold on to it, maybe give you a phone call, follow up with them in every 30, 60, 90 days. And sometimes I've had people reach out 6 months after we sent a letter because they were able to drag things out, try to figure something out, and then they needed to go ahead and move it. If they say no to you, that's okay. Keep them on your list and follow up with them on a monthly basis. Hey, just wanted to follow back up, see you got through what you're working on. My offer, my opportunity still stands as good. So, but that's subject to deals. It's great, phenomenal day, great way for you to acquire real estate. That's the thing with what's going on in the market right now. A lot of people, I'm avoiding. I can't get financed because it costs me. Yeah, for most people, it'll cost them too much, 7-8% for an interest rate. Even if they do a buy down, that's costly. You taking over a mortgage payment that's cheap interest rate, you could hold on to that mortgage for an extended period of time. And it's a great way, like I said, making monthly cash flow arbitrage between the rent rates or the owner finance note, a chunk of down payment or option fees in the front end and the back end to split the equity. So great profit margins. And then as note investors, we see a whole lot more deals and a lot better deals 6 months ahead of time, better pricing. And it's a great way. If you can't buy the note, they might just be a great subject to deal for you to reach out to. So it's we don't do a lot of direct mail marketing, but that would be the one thing that I would do a little direct mail for you besides out to IRA investors. So take advantage of the market, take what's going on. It's a great way to dive into it. And maybe even connect with local subject to deals. There's often Facebook groups of subject to investors in Texas or your state or your specific market. Check it out and see what people are offering. Most of the time, people are wanting way too much of an assignment fee to make it worthwhile. But in some cases, there's still the opportunity to make, pay somebody $5,000, especially if they're not too far along. The bar's not too far along or too behind. That makes sense for a great deal for cash flow over time frame. So look at your numbers. As always, have an attorney review it and go out, take some action, and we'll see you at the top, everybody. Thanks. One of the things that we do focus on, guys, we talk about stuff like this in our WCN membership. You may want to check it out, noteumbrella.com. It's $97 a month. All sorts of great stuff in there. Access to lists, access to me on a weekly basis. We do coaching calls every Monday with that group. It's the biggest bang for buck in the note space. If I can't save you or make you $97, I'm doing something wrong and you can cancel every time. And of course, you get access to all of our past recordings and then all our future recordings as long as you're an active member. So go out, take some action. Noteumbrella.com is how you get signed up for that. Noteumbrella.com. We'll see you at the top.